Hello and welcome to this week's episode of the CNBC-TV18 Investment Guide. I'm Surabhi Upadhyay. Now, you would have heard wise men in the market always say that markets are all about cycles, and that's very, very true. Some of us who've been around for over 15 years observing and reporting on it would know that as well. Why is it important to understand cycles, know them, and understand their timing? That's what we're talking about. And then, of course, we're going to ask our expert today to try and tell us about the new cycles as well. Kenneth Andrade, founder and CEO of Old Bridge Capital Management, is with us to tell us about this very interesting subject. Kenneth, thank you for joining in and welcome to the show.
Thank you. Good evening, Surabhi.
Okay, so I'm straight away going to dive in. Why is market cyclicality an important concept and why should one study it, Kenneth?
Okay. I mean, from a personal context, investing is all about past experiences, and if you spend an extremely long period of time into the marketplace, we've always realized that market always finds new leadership as events go on. And in the past 20-30 years that we've been around, I think very typically the business that creates an all-time high during a particular decade actually gives way to a new construct. I mean, all of that gives a new construct going into the next decade and following that. So through a simple example, and this has got nothing to do with the Indian context really, but even in the US, post the tech bubble that you've actually had, the company that exited 2009 from 2020 to from 2000 to 2009. A company called Amazon, which is now amongst the world's largest in terms of market capitalization. You almost had a flat structure in terms of returns during that period of time. So it's important to understand, or it's important to actually capture a lot of that into your investing process, because you could go through an entire decade having no return if you just stay locked into something that you've seen in the past. And that's the little experience that we bring to the table in terms of what the investment processes are all about.
Okay, so if you could elaborate on that point a little more, when you talk about cyclicality and then that applies to the way people time their entry and exits as well, and just investor mentality or investor behavior, what do you observe?
Yeah, I mean, you step back to 2000 and you had a certain segment of the market which peaked at valuations anywhere between 50 times to 150 times earnings. And that was all had to do with the tech basket that was there. You go into 2008 and 2007 and 2008, everything that had to do with commodities, everything had to do with infrastructure, and everything that had to do with corporate lenders actually peaked out during that period of time. 2015, it was all about pharmaceuticals. Now, these are how stock prices behave, but in the context of what happens to the underlying stock, profitability in that segment expands quite dramatically. Okay, so the nearest that we saw was 2008, okay, or maybe 2015, where you had a cycle in pharmaceuticals. And profitability expanded quite dramatically during that period of time. But when profits actually expand, it brings in new competitions and new competitive pressures that come through. So sometimes capacities expand far faster than demand is essentially expanding, and that to a very large extent creates the top in market cycles. So we need to understand as to where it is and how to capture those inefficiencies in the market. And in virtually all periods of time, it always represents itself in valuations. So valuations actually peak during that part of the market cycle. Valuations peak, all companies within that entire space are profitable, and this is not very good for profitability construct in that industry in the medium term. So if I sum it up, if one industry, all companies are profitable, over a medium term period, it destroys pricing power. because everyone wants to compete to grow faster. And when you try to go faster or try to bring in more capacities, you create an oversupply situation, and that's what typically happens with an industry cycle or with a profit cycle. So we would necessarily need to have to watch for these because winners turn into laggards. You have got to distinguish, because these are all good companies, but they definitely do slow down in terms of profitability.
In terms of their growth. Got that. So, Kenneth, for a lot of people who are relatively new to the market, I mean, they probably remember the infrastructure cycle of 2003 to 2008. Then we've had this big consumer cycle, both on consumer finance and just FMCG companies or consumer names. And everyone's wondering, what's the next cycle? First of all, are we at that point in the market where you see a new cycle kicking off? And if yes, what will it be?
So we definitely seeing a new profitability cycle, and the profitability cycle is continuous. It's not going to stop and then it's going to start again. So if you take marketplace as a whole, or the marketplace as a whole, profitability will always grow, and you've seen that happen or at least I've seen it happen for as long as I've been around. But the profitability growth is always led by some new component of the marketplace. Okay, and if you go back to the last decade, while profit growth has been slow in the single digit, it was led by a whole load of companies in the consumer franchise, financials, and consumer businesses, whether it's consumer automotive, whether it's FMCGs, domestic appliance businesses. So between the liability side and the consumer franchise side, I think profitability was mainly constructed out there. But if we just step back to 2021 exit, okay, characteristically one of the commodity businesses that have come through, or just take the metal back, some of those companies are throwing up cash flow and profitability in one quarter, which is equivalent to the profitability of an entire consumer business, or India's largest consumer business, which is there. So take any of your steel companies, look at the last quarter numbers, and look at any other consumer businesses out there. Now this has happened after almost a decade plus. So are we at the start of a new? Are we looking at new category leadership in that marketplace? Maybe this is just indicative. But if profits hold on, and it's not a tall task for it to hold on, because some commodity prices have just about around their 2008 to 2010 prices. Okay, if profitability holds on, I think there will be reasonable amount of attraction for investors to slightly adjust their portfolios, if not fully adjust their portfolios.
Okay, that's the market as a whole, Kenneth. In terms of themes, what are the new themes where you see a cycle starting? For instance, I mean, before the show when we had a chat, you did mention manufacturing. Is that something you're looking at? You had mentioned green energy and decarbonization. So are these new multi-year themes that are starting out?
I think the Capex cycle will be kicked off by a number of business opportunities that are sitting out there. And you look at most of the mining companies that have put out their presentations. Obviously, the biggest commodity that seems to be benefiting from this entire electric conversion of the automobile fleet globally is copper and everything that's linked to that. So the electrification is linked to a cleaner environment, and at the other extreme, the back end, which is all the power plants that are set up across the world, will also somewhere navigate themselves towards to move away from fossil fuel. Now, this could be a start of, I mean, it's already started, but this could just accelerate its way into the next 10 years or 15 years. The move away from fossil fuel in the longer term is real. In the near term, you just might get some spikes as the entire world struggles with supply deficits that are there. So long term, the the greener environment or decarbonization, as a large part of the world calls it, will be one of the biggest themes that will drive Capex, will drive the Capex opportunity across the world. And that could end up being extremely material intensive. I mean, it will consume enormous amount of materials, because your entire energy basket, your entire energy has to get replaced. Your entire automotive fleet will also move in that direction. And it's got commercial reasons as well as got environment reasons. And commercially, costs will come down. Environmentally, everyone wants lesser emissions in the entire system. So yes, to that extent, we could be sitting on a Capex cycle. What could determine it? This could be just one part of it that will determine the future of it all. But I'm sure there will be a number of other things that will participate along with it.
Welcome back. Here with the CNBC-TV18 Investment Guide, and this week we are discussing market cycles with Kenneth Andrade and trying to identify perhaps the new ones that could be kicking off now. Now, Kenneth, you mentioned Capex, and that obviously is intertwined with manufacturing. With that being the broad theme, what sort of sectors should one look at where this will manifest very quickly, where perhaps there's going to be that big delta on earnings to play for?
I think so. Let's look at just the Indian context of it all, right? And we're seeing profitability growth in segments of the marketplace that has virtually gone flat for probably a decade. And it was manufacturing, whether it's commodities or any other product that is there in the entire cycle. Now it's changing that dramatically. What has changed that dramatically is that there's been no supply in the last decade. Okay, if at all, there's been a massive consolidation of capacities that are there. India's got 6 large steel companies with more than 6 million tons of capacity that is up and running right now, and each of these companies are adding more capacities to it all. So my sense is by the end of the next 5 years, we will have at least 3 large companies in the top 10 in terms of total steel manufacture across the world. So commodities is obviously one big bet that is there, or one big opportunity which is there, which feeds into everything else that is there on the ground. And India's really established itself global footprint with obviously tech, with pharmaceuticals, and with chemicals. The latter two, in the entire scheme of things, are still very tiny from a global context. They're large from an India context, but they're still very tiny from a global context. And as long as these companies continue to remain financially disciplined, they will continue to go out and get incremental amount of market share as more and more capacities come back to India. Then you move down to narrower verticals where we're trying to establish ourselves. There's building materials in terms of ceramics and the derivatives of all of that comes out into the country. We also fairly large in agricultural exports, though we are tiny as far as the global matrix is concerned. So if you look at the footprint from an India context, there are very few industries where we dominate. There is an opportunity to go out and get larger market shares. We are fairly competitive in virtually every industry that we've got a footprint globally, and there is a market opportunity to go and feed into the supply chain that is existing out there. It has to be engineering, it has got to be automotive, it's got to be automotive, which is 2-wheelers, 4-wheelers, and the ancillaries. So I think the spectrum is very wide. But what happens is when we start with manufacturing and that business actually turns around, you always remember it's very energy intensive. And to a very large extent, we haven't seen any significant addition to capacities as far as utilities is concerned. So that's another thing that will drive all of this. The minute you tend to increase capacity utilization, your energy consumption also picks up. So the value chain across the board is seeing a higher utilization levels, and when you drive a higher utilization level, obviously your operating leverage increase, your profitability matrix improves, and your cash flows improve. And and the best part of all of this is that none of these companies need incremental cash to grow. They need a couple of line of credit from the banking system, which is fairly easy in today's context, but there are no other impediments as to more capex required to meet the deliverables. So we've got all the infrastructure ready. The demand opportunity exists. Even if the world goes flat from here in terms of growth, I think we can feed it all into it all. The upside could come through if we have a year or two of inflation, and that probably in the near term is the best for corporate profits. So there are multiple moving parts in all of this. You will tend to I would tend to believe that utilization levels, once things open up across the world as well as in India, will tear upwards, and once that happens, I think the profitability matrix will completely change. So we need this. We need cash flows to come in, and once you had those cash flows come in and you got deleveraged balance sheet, you move into another round of capex cycle, which feeds on to growth by itself.
Okay.
So we've been waiting for this to happen for a very long period of time.
So Kenneth, just to recap for a moment for us, just with. Okay, got that point. Now, within this broader theme of capex, if you could just recap for us the individual subsegments which you're most optimistic on. Of course, pharma and chemicals is something that you mentioned. Which would be the others? And where does infrastructure come in, if at all? Because the last big cycle where the economy did really well, it was all about infra. Road contractors, EPC players, power companies. Any company with the word infra on its name, I mean, the stock prices were just shooting through the roof. So is it going to be different this time?
Yeah, infrastructure will have its play, but it will be very, very narrow. I think the market has become a lot more sophisticated out there, and a significant amount of entrance into that marketplace will be driven by fixed income players see, infrastructure is a very capital intensive business, and you need capital which is cheap, and that creates the opportunity on the other side. So I'm not too sure that infrastructure will create a very large opportunity for equity holders, but definitely for investors who are looking at fixed income. I mean, you've seen the formation of the InvITs and REITs. I think that's a part of the market that will expand and explode over the next couple of years. So it's a little different from 2008 or 2004 to 2008. My sense is we are heading into an economy which is slightly a hybrid between the 90s and the early 2000s. Okay, more outwardly looking companies with significant competitive advantage. The domestic economy would tend to struggle a bit because the government doesn't seem to have too much of growth capital to drive that just now.
Okay, that's an interesting way of putting it, that we perhaps are heading towards an economy which is going to be a mix of the tech economy of the late 90s and, of course, the infra move of the 2005 to 2008 era. So, Kenneth, as we're wrapping up, I believe agriculture is a sector that you seem to like. Is that correct? And if so, then what's the play here? As in, what is it that you're looking at, and how would you play the higher rural incomes or the rural theme?
It's a consolidating market. We've got very few businesses out there. Actually, we've got businesses that only compete with the public state enterprises out there, and they account for a significant amount of the profit pool out there. So when you look at these companies there, so agriculture is 15% of India's economy, and it's going to go down. But as that industry has a growth rate of 1 to 2%, and the economy grows at 6% to 8% or 5% to 8% in that zone, agriculture becomes a smaller subpart of the Indian economy, and that's something that's happened globally. Now, in that basket, you've got private sector and you've got state-owned enterprises. private sector is going to continue to take market share from state-owned enterprises, and they're going to do it without incremental addition to capital. And I think that's where the opportunity for us comes as equity investors. So some of these companies are going to get extremely large because these are almost these are large sub-segments by themselves, and it's not a very well penetrated market, and it's not a very well mechanized market out there. So that is our play in that small window of opportunity which is sitting out there. Valuations are great. Businesses have consolidated. Cash flows are very robust, and some of those private sector businesses are sitting with all-time highs in terms of market shares, all-time high in cash balances, and are incrementally taking incrementally more market share. So slightly different. They're in a very different cycle. They're in a very different market cycle by themselves. And it's got nothing to do with the macros of farm incomes. It's got nothing to do with the macros of incremental farmer wealth or any of that. It's just pure consolidation of a business, brand building, distribution, and incremental cash flows. So that's the context of that's the limited context that we have when we allocate capital out to those businesses.
Okay, that's an interesting thought, and perhaps if it is the factors that you described, then it's not contingent on the amount of subsidy coming in or government policy, then it is indeed perhaps a longer term cycle that can play out. So Capex on one hand and agriculture on the other, two big themes to watch out for. Kenneth, it's been a pleasure having you on the show. Thank you very much for being with us on CNBC TV18 Investment Guide. Well, that's a wrap on the show for this week. Thank you for watching. We'll see you again with another theme next week.